In this video, we are going to see top 5 indicator for successful trading. Number 1. Moving averages. Moving average is a technical analysis tool that is used to smooth out the price action of a security or index. A moving average is calculated by adding up the closing prices over a specific period of time and then dividing that sum by the number of periods. The resulting value is plotted on the chart as a line which moves up and down as the price of the security or index changes over time. Traders use moving averages to identify trends in the market and to determine potential entry and exit points for trades. Moving averages can help you identify trends in the Nifty. For example, a crossover of the 50-day moving average above the 20-day moving average can indicate a bullish trend, while a crossover of the 50-day moving average below the 200-day moving average can indicate the bearish trend. Number 2. Relative Strength Index Indicator. In short, RSI indicator. The RSI is a momentum indicator that measures the strength and speed of the price movements. It compares the size of recent gains to the size of recent losses in an attempt to determine whether a security or index is overbought or oversold. The RSI ranges from 0 to 100 with readings above 70 indicating an overbought market, reading below 30 indicating an oversold market. RSI indicator is a momentum indicator that can help you determine whether the Nifty is overbought or oversold. For example, an RSI reading above 70 can indicate an overbought market, while an RSI reading below 30 can indicate an oversold market. Number 3. Bollinger Bands. Bollinger Band indicator are a volatile indicator that uses standard deviation to determine the upper and lower limits of a security or index's price range. So it uses the standard deviation, that is the one of the statistical term. The upper band is calculated by adding 2 standard deviation to the moving average, while the lower band is calculated by subtracting 2 standard deviations from the moving average. Traders use Bollinger Bands to identify potential level of support and resistance and to determine whether a security or index is overbought or oversold. Bollinger Bands are used to measure the volatility of the Nifty, Bank Nifty, etc. The bands widen when the market is volatile and contracts when the market is stable. A break above the upper Bollinger Band can indicate an overbought market, while a break below the lower Bollinger Band can indicate an oversold market. Number 4. Moving average convergence divergence indicator. The MACD in short. MACD is a trend following momentum indicator that measures the relationship between 2 moving averages. The MACD is calculated by subtracting the 26-day exponential moving average from the 12-day exponential moving average. A signal line is then created by calculating a 9-day exponential moving average of the MACD. Traders use the MACD to identify potential changes in trend and to determine potential entry and exit points for trades. It consists of a fast and slow moving average and a signal line. When the MACD line crosses above the signal line, it indicates a bullish trend, while a crossover below the signal line can indicate a bearish trend. Finally, fifth one, Fibonacci retracements and pivot point indicator. So we are going to combine the both. We'll see which one is better, and when combining, what is the benefit. So fifth one, Fibonacci retracements are a technical analysis tool that are used to identify potential levels of support and resistance. The retracement levels are calculated using ratios derived from the Fibonacci sequence. For example, 1, 1, 2, 3, 5, 8, 13, 21, etc. The most commonly used Fibonacci retracement levels are 38.2%, 50% and 61.8%. Traders use Fibonacci retracement to identify potential entry and exit points for trades based on the expectation that a security or index will move back towards a previous level of support or resistance after experiencing a retracement. The other case, pivot points. Pivot points are calculated based on the high, low and closing prices of the previous day or period. They are used to identify levels of support and resistance that can be used to determine potential entry and exit points for trades. The most commonly used pivot points are the daily pivot point, which is the average of the high, low and closing prices of the previous day, and the support and resistance levels that are calculated based on the pivot point. Both Fibonacci retracement and pivot points can be used together to confirm levels of support and resistance. For example, if a Fibonacci retracement levels and a pivot point level both coincide at certain price level, it can provide a stronger indication of a potential level of support and resistance. That's all about the top 5 indicator for successful trading. If you like the content, please click the like button and subscribe for my channel. Thanks for watching the video.